Moving on to the next session, I'm reminded of a very apt quote. Experiences and not transactions, which are insight-driven and instantaneous, is what we need. And who better than an experienced person to discuss and another experienced person to moderate it? To moderate the keynote session on direction of investments in fintech, may I please invite Shamit Chokshi. Shamit is the head of offshore fund investments at ICICI Prudential AMC Limited. He also serves as the chairperson for the Professional Learning Committee at CFA Society India. Shamit, the floor is yours.
Hi everyone, thanks for making it to the event, and it's a pleasure to be in Bangalore here. And yeah, we are on time. That's commendable. So thanks, Megha, for the quick introduction. So just to moving on the next session, the background, it's a very simple session if you see the topic, it's very, very need-based in the current market environment. But, essentially, it's an opportunity in a difficult scenario. The Indian fintech funding industry has seen so much of funding in the last few years, almost $35 billion as per a recent report. And just about $9 billion in 1 year. That's a lot of money for industry that needs to move up the curve on regulatory compliances, investor protection, and a sort of a subsegment of the market where credibility matters more than innovation eventually. I would say emerging technologies, demography, the shifting cultural changes that are happening in the way we buy financial products definitely are acting as a great push towards growing the assets in fintech. But on the other side, as an asset manager, we are seeing a lot of challenges. The rise of interest rates globally after a 10-year period of almost free money sort of concerns us. I think how will the fintech industry play out in the new global economic scenario? How will the cost of leverage impact institutional funding in fintechs? And will there be, for the first time, will we see a lot of focus on quality of business versus market shares and innovation? I think these are some of the questions that sort of come up all the time in our debates in our CFA society groups as well. I would also believe that institutional investors and venture capitalists would possibly relook at their screening processes now that they have more choices and the cost of money rises. So it's important for the audience to understand where we are headed in terms of the direction of investments in fintech. And that is the topic for the next session. To introduce our speaker for today, well, he needs no introduction, but TC Meenakshi Sundaram, affectionately called TCM, is the founder and vice chairman of Chirate Ventures Investment Advisors. He has obviously more than 4 decades of experience in the industry and over 18 years within the venture capital businesses. He is on the board of companies like Lenskart, Agrostar, Vayana, Crystal AI, Metadom, amongst others. Well, he's obviously very well regarded in the VCPE community locally as well as in various parts of the world. In the past 15 years, he has had tremendous success in investments, exits, capital raising, as well as building out emerging businesses in fintech. Some of his successes include, opening new investor platforms such as Rupee Capital, DFIs, and insurance company partnerships. Obviously, before his role at Chirate Ventures, he was part of Walden International, where he was involved with investments in Mindtree, Venture Infotech, and JobStreet. Before Chirate Ventures, TCM served as a chief financial officer and president at Venture Infotech, a leading payment processing company in India. Before Walden, he has worked for over 14 years at Wipro, where he last served as general manager for the e-commerce division. So the next, obviously, we'll ask TCM, sir, if you can come up on stage and give a good introduction presentation on the topic, after which we'll take up a moderating session. Thank you.
This has a commercial break about Chirate Ventures, right? So I don't know if you guys can see me, so they will be comfortable with, right? So cryptos will be under question mark unless they actually have some underlying value that they can create. But blockchain adoption is moving very, very fast, right? Across in trade and finance in India, actually the LCs are being moved across. There's a consortium of banks which have come and done it. And recently, just 2 days ago, RBI started the CBDC, where the government security trading has moved on to that, right? Starting days, but I think CBDC will have a very interesting way. Again, the friction point, the T+1 or T+2 that people talk about. In blockchain world, with a smart contract which can execute it, it's not just at a trade, it's also the cash moving mechanism and the security moving mechanism can be combined into one. You will find that actually T plus at 0 can happen, right? That is what it will come. Cost of executing, that means you don't need a human intervention at all. That means cost of executing will go down. So what you will find is that over a period of time, things which could not be done because I cannot have a branch, I cannot have a person to do stuff, all will become doable, right? Like we saw in UPI. But I think but the biggest risk for existing players is that the profit pools will be threatened in a significant way, right? So one of the reasons why in India, after the UPI and MDR reductions and things like that, there is not much of money available in payments, right? But huge volume. So even if somebody takes 1 paisa of a transaction, it's a huge volume, right? But that is how it will happen. But another thing that we notice, like I said, I think Vayana, which is there today doing trade finance in India, they are also going to do trade finance in the international trade, right? Not only for India. So they got a GIFT City entity that can actually do for all the, and India is the third largest homogeneous market in terms of people to play with, right? US, China and then India. But whatever works for India can be implemented across emerging markets. So India innovation is not only for India innovation. India innovation will service 7 billion people. So this is not for the top 1-2 billion people who can afford anything, right? India, in whatever, if you can make anything operate profitably in India, right? So Indian customer expectation, whether it is B2B or B2C, so they want BMW at a Maruti prices, right? So you get the best in the world in terms of features and capabilities, but at the most frugal cost. If somebody can make it work and make it profitable, right, the whole thing can go globally. And you can then compete with the first world companies also, right. That is what we are seeing today. So our own SaaS view is that India will create 100 billion of SaaS revenue, and which will cross a market cap of $1 trillion in the next 4 to 5 years time, right. Whether it happens 4 or 5 years or 6 or 7 years, I don't know, right. This is directionally, but we are on a very interesting scale. B2B is a huge opportunity because payment flows in B2B are still high friction, where banks still play. SWIFT is there and international and domestic. Indian RTGS or UPI are like rocket science for US markets, right. That's the reality, and that we will go and change. That blockchain will make it change. And so this is an opportunity, B2B and everything related to B2B payments, B2B technologies in financial services will be huge opportunity going forward. One of the important things on investments, right, is that initially valuations will be based on tech, but eventually this is a financial services play where tech is used as a disruptor and not as an enabler. So while exiting time comes, right, when companies scale, when they go IPO and things like that, or investors want to sell, you are going to find an interesting phenomena saying that they will get compared again with based on what is your book, what is your ROA, what is your ROE and all of those things, right. People cannot escape it, but if you have better operating efficiency, the same way a Bajaj Finance or HDFC Bank gets a different multiple compared to let us say somebody who has a very poor NPA rating, that will happen. So, operating efficiencies and book efficiencies will be priced in terms of different valuations, but eventually to come back to this question of whether fintechs are going to eat the existing players, they are not, they will coexist, but at the same time with every innovation there will be some which will come stand forever, whereas a few of them will get absorbed by the existing players. And you will also find some of the bigger players in the fintech who will be independent will absorb some of the traditional players, right. That will also happen. So, if traditional players do not adapt, then they may get absorbed. Thank you.
Very quick question, the last slide mentioned it all. You said fintech players could possibly buy out traditional players at some point with scale and profitability. So, a lot of questions have come up saying that we have apps like YONO for SBI, and also there was a question that already traditional players are implementing most of these ideas in their traditional business. So, what are the strategic opportunities out there as an investor? Would you rather place your bets on traditional players evolving as fintech players, or do you think that the fintech players hold the value chain?
It's like this. We are investors who look at disruption, right. So, we do not go and invest in a traditional player, right. So, to that extent we believe that the speed at which a disruption takes place, the traditional players are not able to match it. That is something that we see happen across the board, and I think we will continue to back the disrupting technology players, but we believe that some of the larger players who are adapting technology, and they are also adapting it in different ways, right. So, if you look at it, there are few players who are dealing with every fintech, saying that okay, I am here, I am providing you let us say a regulatory oversight, but then you go do it, and then they deal with every fintech available. There are few who say that I will build everything in house, right. I have a feeling the first type will be much more nimble in the traditional players. The second type will always be catching up. So, to that extent they may actually lose out in terms of market share or leadership. That is the big risk that they run.
Okay. So, now I think just continuing from that topic itself, financial services is largely a regulatory landscaped sector, and essentially Indians typically focus a lot on investor protection, and one mistake can bring the house down for financial players. So, clearly traditional players have the edge in terms of manufacturing experience. They have seen cycles, interest rate cycles, NPA cycles. How do you see fintech players evolving in the next few years, given that as an investor for you the cost of funds also goes up, and the barrier for a startup literally becomes very, very high now, and we haven't seen this cycle before. So, from your experience, how do you see this will play out for the fintech players going forward, and should they pivot from just being an aggregator of customers and technology to becoming a manufacturer at some point?
No, I think it is a necessary thing even to participate in the larger part of the profit pool. To answer the last question, all of them, what are they doing? They are using technology as a disruptor to be able to first get a stake in the table, right. Just like a retailer will start with only selling others products and then later move into private label. All these, once they own consumer, give a great user experience. Once they own the consumer, then they can actually become partially a manufacturer. In some areas it becomes a challenge, where you participate with, let us say, whether you will compete with your customer, with a B2B partner, right. In those situations it is a little tricky, but otherwise I do see that in a model like co-lending, then you anyway have to have build your own book, right. The interesting part where technology comes in and the platform play comes in is that a startup, fintech startup can either compete with all the existing players, and that will be with such a headwind, and to gain 1% market share will be substantially challenging. But a fintech, which is a platform where it partners with others, can quickly ramp up to influence 10% of the market, right. So, those will be the interesting plays that they will do, but it is a partnership, but at some point of time they will say that, okay, out of, if I am influencing 10% of market, let me do 10% of that on my book, let me do 10% of wealth products on my own, or in some form participate in an insurance underwriting, risk reward. Those things will start happening, because they have to also increase their profit pool. Right now many of them are actually maybe losing money because of overheads, right, while unit economics may be there, but they have to become profitable to be actually valued meaningfully.
Interesting. I'll take up a question which came in quite early actually. Some believe that with access to account aggregators and OCEN platform, banks will be able to underwrite high loans with much more ease. What will be the impact of this on fintech, which essentially have targeted the high yield segment first?
Yeah, so I think my belief is that that is an interesting assumption, but we have not seen that happen in reality. It's not about whether they have underwriting capability, it is a question of whether they want to build out more in terms of looking at additional data, right. So, these railings will come, these pipes will come where data will flow, but how they use the data is what is important, right. That is where the challenge I see in it. It's not that banks were not aware of or availability of this data even in the past. These pipes will make it easier, that is the only thing. So, so far I have not seen it. I hope some of them actually adapt and do better.
Okay. So I think that takes me to the next question on buy now, pay later. We've had a session on it already, but from a commercial standpoint, how credible is the data out there when you're looking at investing in these companies? What are the ethical aspects that you will deal with, given that we've heard news that a lot of Gen Z or Gen Y borrowers are facing crisis in some markets because they were not sophisticated enough to understand the product. Do you think investor awareness has been a letdown among fintechs, and as an investor, how would you advocate them to move forward?
See, one thing is, I think in BNPL there are two types of BNPL. One is that which is very short term. So, you do not have a credit card. So, I am giving you a BNPL where you can buy whenever you want, instant gratification, but pay at the end of the month, maybe 30 days. So, just like credit card gives you a credit, you give 15 days or 30 days type of credit, right. That is one type of BNPL. The other one is where people are actually saying that the EMI model of buying the equipment or any capital goods or consumer durable will move into BNPL models, where people do not necessarily have credit history and things like that. I think the second one is something that I believe is still in nascent stage, and that is where I think Bajaj Finance has built a phenomenal platform, and the fintechs are looking at it. So, those who are going into that market and build it, because it is a longer term credit, right, it could be a 6 months, 9 months or 12 months credit, will be interesting to watch. The one which is short term, I think you will face some challenges in the near term. But if you talk about investor awareness, I think end of the day this is a consumer world, right. So, the world has changed where in my days possibly I would have waited for my salary to come before deciding to buy a mobile phone, right. And today people If they want to buy a mobile phone or if they want to book a holiday in Goa, then you do it, they want to do it now, right. So, that instant gratification is moving in this. I do not think anybody can change it. If credit is available, they will take it.
Okay, I think so. You are suggesting some sort of consolidation in the medium term, and not all BNPL players would really scale up to the levels required.
Yeah, so the technology world is very brutal, right. So, typically this is the top 2-3 players will be the, it is a winner take all type of market, because there is no infrastructure that is there saying that okay, I have branches and things like that I have to open. So, I have a headroom for somebody else, or I have a moat for somebody else to come, right. Tomorrow morning a new company can come, they can disrupt an existing player for 5 years, right, very clearly. So, this is a brutal world where let us say 1000 companies start off or even 100 companies in BNPL. Fast forward let us say 5 years, you will find maybe 3 to 5 companies which will exist. So, some will be horizontal players, some will be vertically focused. You have seen that in e-commerce play, right. There is, we have seen so many other companies, but now there are 2 guys standing. In food delivery you saw that, right, because capital will go after people who are building leadership and others will not get capital. So, those will either pivot to being service providers, or they will pivot to getting, or they will get absorbed either by the tech players or by traditional players.
Okay.
Consolidation is the name of the game.
Thanks. So, in one of the reports you did with a consulting assignment, I think with a large firm, you mentioned $1 trillion of assets under management and $200 billion of revenues. That's a very astounding number. How would you sort of break down the assumptions behind this, and which parts of fintech you think show maximum potential for ROE for investors who are going to bet their?
Yeah, so this $1 trillion has got three parts to it. I think one part is about $515 billion is in the lending side, right? Both consumer and SME lending. Just imagine in an 8-year time frame, India will be at more than $5 trillion, right. So, when you look at that level of growth, and then within that you will find fintechs growing at a much faster pace. Like I said, they comfortably grow at 100%, right. At that pace they will increase market share, right, and that is what we see. And there will be to some extent fintech influenced books also will be there, right, because of co-lending. The other part is wealth. So, wealth is something where today the relationship manager cannot be afforded for anybody who has less than a crore of investable capital, right. Now, how do you manage that? Anything less than that, and in fact, in terms of global majors, they do not service anybody less than $10 million of capital with RM, right. You go to UBS, $10 million, maybe Julius Baer will say $5 to $7 million. But starting from $1 million to 5, 1 million to 10 are sophisticated clients who understand the structured products and others which are available to wealth, but are not being serviced. And that is where fintech will come, where RM is not required. The interesting part is this, starting from millennials, they are very comfortable with using technology. They are not necessarily saying that I need a face-to-face relationship manager. The older generation will say whatever technology is there, I like my RM to come and meet me once a month, right. The new generation does not even want to meet parents, right. So, where are they going to meet RMs? Yeah.
So, I have 2 questions for you. We are obviously slightly above time, but we can take that up. One is what are the key risks for the fintech players and the businesses you discussed here, very briefly, as an investor. And second, the ethical aspects of fintech lending. A lot of people have been asking me questions about fintech lending becoming very consumer focused and not sustainable for the borrower. So, how would you advocate that thought as an institutional investor?
Yeah. What was the previous question?
The previous question was on this different segments of fintech and how they will consolidate.
Yeah. So, I think, so one of the things that that we see is that this innovation will continue. As an investor, what we see as a startup, I think they will keep innovating at the periphery, at the intersection of, let us say, two regulations, right, and it will take time for new regulators to catch up with. So, we will find that they will always be ahead of the curve, the fintech companies, and it is fine because they are pushing the envelope for regulator to catch up, they are pushing the envelope for economy to catch up, and they are solving for a real problem. So, but they have to become unit economic positive, they have to become profitable. So, they will have to continue to do that activity. So, the discipline that you were asking about, saying that is necessary. They should, the risks that a fintech has and the investor in fintechs have is that they should not think that they are isolated from the regular world, right. We are not in a meta world, right. This is a real world where real money is being transacted upon for any activity. It is a financial services business with high regulations. So, if somebody thinks that they can actually be clever about circumventing regulation, that will not happen. That is, in my mind, that is the biggest risk that people should be prepared for, and they should build that regulatory muscle right from day one. It does not happen overnight, it will not happen as an afterthought. We have regulators who write the law, who are also prosecutors, who are also the judge, and there is no appeal, right. So, to that extent, they have to be very careful in terms of how they trade, and it is the responsibility of the investor also to educate the young entrepreneurs, saying that you cannot live without regulation. So, think ahead of it. In fact, when we evaluated a company in the blockchain space, actually crypto space, crypto trading space, we said actually go get go to SEBI and then discuss with them before we invest. Submit a letter, get a clearance from them before we invest. This is what we mandated to them, right. That is the responsibility of an investor also to think, saying that what are the regulations that may come and affect. So, that will be the risk.
Sure. I think we're already up on time right now. So, obviously, sir is available in the break outside as well if you have any specific questions. But thank you, sir, very much for joining for this session. We appreciate your views.
Amit, for a very interesting session which had a lot of subsessions in itself. May I please invite Priyanka to hand over a token of appreciation to Mr. Sundaram, Shamit and Ravi. Ravi, can I please invite you on stage?